we're actually talking about something that I don't think anyone on YouTube has really like discussed. And you enter into a contract with the insurance company, their actual liability is not the cash value, it's the death benefit that they're on the hook to pay you.
If I put a death benefit in place, that insurance company owes me, my family, that money when I die. They don't care if I borrow it now or if I die 20 years from now.
Hey guys, welcome back to another BetterWealth Reacts. It's not just me. I got my good friend Matt Love in this reaction as well. And we're going to be reacting to a video that Matt did on his Instagram. And Matt, it's gotten over 1 million views on your Instagram. It went totally viral. And then this person named Edward Collins reacted to your video. I remember watching it and sending it to you, and I'm sure many people sent it over to you. Edward, does a lot of reactions to people's TikTok and clips, and he seemed to disagree with you or kind of like, have a different take. And it was fun for me to watch this because I knew exactly what you were talking about. I understand and agree with what Edward's talking about. And so what I would like to do is I would like to watch this. I would love to hear your reaction, and then I would love to have a discussion because I think this is the kind of content that I think will make us all better by having a deeper conversation about. And so without further ado, let's jump into the clip.
How often do you have to make a mortgage payment?
Once a month.
Once a month. Because it's a recourse loan. What happens if you stop making the mortgage payment? So the collateral is your house. The bank isn't just going to give you 87 grand to go enjoy. If you stop paying it back, the bank gets the asset. You follow?
Yes.
In life insurance, my collateral is the death benefit. The company's already on the hook for millions to my wife when I die. I'm going to call the insurance company and say, I want to borrow 100 grand. I'm going to borrow against the death benefit. If I never put the money back into my policy, when I die, my wife gets the million minus the 100. She gets $900,000.
The chase. When it comes to loans and life insurance, that loan is between you and the life insurance company, not between you and the cash value or the death benefit. And that life insurance company is going to collateralize that loan. But they're not collateralizing it against the death benefit. They're collateralizing it against your cash value. Here's the problem. If you do not properly structure that policy with regard to the death benefit relative to the cash value buildup and the guideline premiums, you could end up in a scenario where the loan outstanding with all of the accrued interest has exceeded the cash value buildup within that policy. When that happens, that policy will lapse, and that could create a taxable event for you while leaving you without coverage. Now, don't get me wrong. I actually think life insurance is a good tool.
So what's your initial thoughts when people started sending this to you? What was your initial thoughts?
Well, at first, when people started commenting and stuff, it was cool because you get positive and then you get the haters, right? The hard part with this and social media and short clips with reels is, it's hard to tell the whole story, right? You have hours. I have hours of content that teaches how insurance works. So first thought is that this is a clip of a much longer conversation that I was having with a client. And it was fun to watch it go kind of viral and all these people are reacting. I mean, all these followers came out of the woodworks, which is super cool. I mean, you do organic too. So that was fun to see. And then he's not the only one that had a reaction. I also think, I don't know what the term is, but not unlike what you're doing, it's 4 reactions and to help people understand it. So what he's doing, his intention is very good to help people understand the details that I perhaps left out. And he's leveraging somebody else's content. Not unlike what you and I do with other people anyway. So, dude, am I mad about it? No, not at all. I'm glad that the clarity came out because there are things that I didn't mention, unfortunately or fortunately, because it sparks this dialogue, which is really what the internet I think does a better job of allowing people to learn if they can go deep enough. So, I wasn't mad at it at all. It made me laugh because literally, dude, 12 people sent me that video and I was like, and somebody said, you're going to get a lot of followers. I'm like, I don't think I will from that. I got a lot more from just posting the video rather than this guy's reaction. That said, this guy's stuff is really good. Like that guy has stuff coming out constantly on pretty cool topics, but they're short clips, right? And the thing that I don't like is that you take somebody's content, then you swoop in as if you're the authority, the authority in that space. And people just say, okay, now he's the authority. Well, kinda. I don't know.
I think attention, like the person that has attention, for better or worse, authority comes with it. What is your
Think about
initial
this.
thought? So
Really quick, negative attention is still attention. Just ask Donald Trump.
Yeah, correct. All right, so let's talk about what you said in the video. You made it sound like, okay, you're borrowing against your death benefit. I actually know what you mean by that. And so what he's taking what you said literally and saying, no, that's not true. I have had people in the past that have heard something, a message, and they actually get mixed up and they're like, oh, can I take a borrow actually against my death benefit? And we have to explain what we mean by that. So instead of me explaining, I would love for you to take like a responsive, like, what do you mean by that? Is there anything that you disagree with what Edward talked about? And, or what did you mean by you borrow against your death benefit?
So not that I disagree with what he said. I think he also left out a few points if we want to go that detailed, but, and I like the way that you've said this in the past in conversation with me. So in order to have cash value, I have to have a death benefit. And this conversation that I was having with the client was talking about using the cash value. And an easy way to explain a non-direct recognition loan, in other words, an easier way to express how to borrow against the life insurance contract, my cash value is going to grow forever. So when I'm borrowing money from the insurance company, not myself. And so my cash value is going to grow. If I die with the loan outstanding, the death benefit is reduced by the amount of the outstanding loan plus interest, which somebody else pointed out. But then they also ignored the dividends that are on the gross value of the cash value, ignoring the loan. So there's so many details here. So if I die with the loan outstanding, the loan plus the interest is taken off the death benefit to my family. So if I go buy a sports car with the cash value and I die, my wife gets the sports car minus whatever I took out, minus the interest, and then that death benefit's tax-free. What he mentions of how you structure it properly, obviously that's what we do, right? I mean, that's the whole point of it. I'm not saying go buy term insurance and borrow against the death benefit. There has to be some level of integrity here from the listener's perspective, right? Anyone who just goes out and buys term insurance, say, I'm going to go borrow against it without actually having a conversation about that before underwriting, before application, before giving the insurance company money. That's a big mistake. So it's the type of contract that we use. The non-direct recognition, I think, is important because that's why when you talk about the death benefit's going to pay off the loan, my cash value is still growing, and so is the death benefit technically, without recognizing recognizing the loan amount. And you also can have riders in companies that you and I use, an overloan protection rider, so the policy can't lapse by taking too much money out. So that's like, it's a scare tactic. Yeah, it could, and quite frankly, if it does, it could be a massive taxable event on money that you actually never realized. It could be a really big problem. And that's why insurance companies realize that, and they create a rider on the policy that doesn't allow you to take out too much, so that can't trigger a taxable event. That said, it's also not for everyone. What I think is so funny when you get all these negative comments about insurance, and then they compare it to the S&P or 401 and all these other things. That's not what insurance is for. It's not an investment. It shouldn't be compared to an actual investment. There's different reasons to make different financial decisions. And when you realize the tools that are at your fingertips, now it helps me make a better decision. And unfortunately, life insurance is completely misunderstood. It's yes, the death benefit provides for my family. Now I have cash value guaranteed growth that I can use. And now I have permission to take risk with my investments outside of the policy. And that's what I was talking about with that client, is like to use the cash value to go buy rental properties. And there's no debt service like there is with a mortgage. Why, it's beautiful. So is it for everybody? No.
That's because you have a permanent death benefit. So the way that I explain this is life insurance is a contract between you and an insurance company. It's unilateral, meaning if you do your end of the bargain, they're on the hook from day one that contract is signed till the day that you die. Okay, so it's a contract. Not all contracts are created equal. You have to. So that's one thing that we could dive into. Not all companies are created. Not all parties that you go into contract with or business with are created equal. So those are important
across the board, though. I mean, that's not unique to life insurance either.
Right. But then if you go deeper, there's only, in my understanding, there's only one real institution out there that allows you to have an unstructured loan. What do we mean by unstructured? Meaning you can take a loan and not have to pay it. Like you said in the video, when you take a mortgage, you have to pay. Even if you take a HELOC, the bank could change the rules and require you to pay that. There's certain other loan products out there that create that flexibility, but at the end of the day, their institution needs to get paid from a cash flow perspective.
There's red tape whenever there's a loan, right? The question is how much red tape in each project.
When you enter into a contract with the insurance company, their actual liability is not the cash value, it's the death benefit that they're on the hook to pay you, and it's a permanent. So it's, unless the contract is void, they're going to have to pay at some point. So the reason that they're like the only institution out there that are like, you can take out a loan and not have to repay it, because we ultimately are going to get repaid eventually, because we have this liability on our balance sheet called your death benefit that is going to get paid to your estate. And what we'll do is anything that's outstanding, any outstanding loan will just get subtracted from that. And so when you say that you're borrowing using the death benefit as collateral, and I don't want to put words in your mouth, but it's essentially, it's like the ability to have an unstructured loan and be able to do whatever we want is only made possible because of the death benefit. Of course, you're not borrowing from your death benefit. You're not, the cash value and death benefit in a way is collateralizing your ability to do that. Because if all you had is the cash value with no death benefit, you wouldn't have the same access to the cash with the same unstructured loan. So I think this is the reason I'm so excited to talk to you about this, because like we're actually talking about something that I don't think anyone on YouTube has really like discussed. And this is what gets me excited, because there's nuances to every subject, and it allows us to dive into it. What is there anything that you want to say on my little rant?
You mentioned there's only one company that has a non-recourse. You said one company. What were you talking about there?
There's only one like institutions that can give unstructured loan payments. So I'm not saying one company in general, but like insurance companies.
Yeah.
I don't know of any other institution that allows you to take loans and not have some type of payment schedule. Maybe reverse mortgages have a version of that, because it's like, so I think reverse mortgage has a version of that, but it's still not the same. It's nowhere near
No, and that's the cool part when people talk about investing, and anybody in real estate understands the value of other people's money. Well, other people want to get repaid. If I put a death benefit in place, that insurance company owes me, my family, that money when I die. They don't care if I borrow it now or if I die 20 years from now.
Yeah.
Right. So that's why they don't care to get paid. And if I'm using the cash value should also not be staying in the policy. It should be used. So if I pull it out to go buy an asset, let's say I flip a house. Well, if I use a mortgage to flip a house, I'm going to have to pay debt service for those 6 months while I'm rehabbing the house. If I use my cash value, I don't have any debt service for those 6 months, because they don't care if I repay it. When I pay the loan off, there'll be interest, but I better make a good rate of return. The only reason I would take money out is because I can get a rate of return better somewhere else that I can control. Real estate, business, your friend's t-shirt company, I don't know. But I want to be able to use that cash and not be required to repay it on their terms. Something else that's crazy, because HELOCs are pretty dope. I have a HELOC. That interest rate is not the same as when I bought my property 2.5 years ago. It went from, I think it was around 4 when we started. It's like over 9% now. Okay. Insurance companies don't do that. Insurance companies change the interest rate to borrow. They can change it on a monthly basis, but for the most part, on the anniversary, that interest rate is locked in for 12 months. So it's not going up. Like I literally had a meeting this morning with a real estate investor, and he's like, with rising interest rates, it's not as attractive to borrow. Yeah, it is. The rate to borrow is 5 from your insurance contract at this one company, and it's not going to change for 12 months. Your HELOC doesn't do that. The bank can call the loan. I met a guy years ago had a bunch of a big business in Michigan, and he was banking through a very well-known bank. I guess I won't say the name. And they called the loan on him, dude. It bankrupted his company. Don't be debt-free and broke, because solvency is better than debt-free. I'd rather have the ability to pay off the loan, but you better believe I'm going to go borrow money at 4, 5, 6% because I can get a better rate of return elsewhere.
Yep. There's a lot of nuggets. I think life insurance is so misunderstood. Unfortunately, there's a lot of people that sell it and promote it that aren't doing the industry and our profession a favor. They're selling it as an investment. There's a lot of bad actors in this.
And you know what's funny, dude? You can make numbers work in your favor if you know how to make a calculator or an Excel sheet. And you see guys out there using these calculators with how you're double dipping and creating the arbitrage and a great rate of return. Look, dude, I'm not going to lie. Life insurance rate of return sucks. You're going to not get a great rate of return, but you get access, you get use, liquidity, control, death benefits, you get waiver of premium. If I get disabled, my insurance company is going to pay all the premiums for me. When I retire, here's something interesting too. If I have $1 million in life insurance, I would need $3 million in a 401k to duplicate the cash flow that it can produce. So the industry wants you to take risk, and they tell you the rate of return on life insurance is so bad. Well, relative to what? There's no tax, there's no fee, there's no market volatility.
Yeah, and it's also like it's impossible to measure an asset. It's a lot of people want to compare an apple versus an orange,
It's
and
because
it's
it's
like
easy.
when you understand like the multi benefits, you have to be educated on every single benefit you're getting by having life insurance as a part of your portfolio versus not. I think
Yeah.
when you educate people on all the benefits, it's like, oh, like the rate of return doesn't share the whole picture.
Yeah. And what I love about doing this is you don't have to apologize to a client when the market goes down. The S&P dropped 20% last year. I had clients getting 30, 40% cash on cash rate of return inside of a policy just by making a deposit into the policy.
Yeah.
Policy went up. So you don't have to apologize. And I found it liberating. So in the beginning, the first few years, you learn how stuff works, how the policies work. You learn how to compare it to all these other things. So a lot of education went into like learning the career. But then I had a moment of clarity, probably 3 years in, a moment of liberty where my job isn't to care for this more than somebody else. My job is just to show somebody how it works. Their job is to say yes or no. Do I want this?
Yeah.
And so if I can just get really good at helping somebody understand what their options are,
Yeah.
now I'm hands off. I'm not even responsible for the rate of return of the asset, like an asset manager who's throwing darts on a wall saying, I think the stock market's going to go up. I don't have to do any of that. Now I can allow clients the permission to go take risk in something that they want to control, like real estate or business.
Yeah. It's good stuff, man. Is there anything else that you want to say? I appreciate you coming on and sharing your perspective. And I just love having conversations with you because you're very articulate, and it's been fun to just grow in our friendship together and just see
Yeah,
like
we've been friends a long time. When I met you, I don't think you were shaving. I think you
I
just
definitely
got your
wasn't. I didn't
first
have anything
car,
shaved.
16 years old. Yeah. Well, at least are you 20? We can get a beer now, can't we? How old are you now?
I'm older. I'm old enough to drink. Yes.
Caleb, you've done a wonderful job with your business and helping people. I love the free education that you give out. Thanks for having me on again. And yeah, man, it's great. I love what
Yeah,
you do.
I'll make sure that your contact info and the way that people can follow you is down below. And let's get you back on, and let's maybe you'll have more viral clips that we'll have to explain on here. But thank you
Hey,
for
man.
coming on. And I think I might just like title this "Borrowing Against Your Death Benefit." I think that's going to get clicks, and I think that people are going to be able to really learn through this. And it's something that to date I have not really shared or articulated well on this channel, and I think it's going to elevate our audience's IQ. And so for that, thank you.
Yeah, no worries. As you're talking, I think that's a great title because people will be like, that's not accurate. But there's another conversation that people say, like what Dave says is when you die, you don't get the cash value, you just get the death benefit. And comparing these conversations to mortgages and housing is really appropriate because there's a lot of similarities. And it's almost like you just do a list of like pros and cons down the whole thing. So we could do a whole other video on that.